So we're going to discuss some ways you can identify emotional trading problems and how to. We're going to discuss 7 tips to avoid emotional trading and how to proceed forward so that you can trade objectively in the market. The first one is identify your personality traits. One of the keys to developing successful trading psychology is identifying your personality traits early on, and you need to be honest with yourself and say if you have impulsive tendencies or if you're prone to acting out of anger or frustration. And if this is the case, then you have to keep these traits in check while trading, and you can't let this lead to making rash and ill advised decisions rather than approaching the market very objectively and pragmatically. It's also important to play on your personal strengths. For instance, if you are naturally calm and calculated, you can take advantage of these personality traits during your time in the market, especially if you're trading like small cap stocks that have often very volatile movements, can move between 10 to 20% within a matter of seconds. This would be a very effective kind of stock for these type of people that are very calm in these types of situations. Equally as important as identifying and being aware of personality is to recognize your biases, as we had gone over above. And these biases are innate aspects of human nature, but you should be aware of what these are on a personal level and how to improve these biases and move past them. Number 2 is develop and follow a trading plan. This might be the most important proactive solution here. Having a trading plan is paramount to being a trader that accomplishes all your goals. And a trading plan acts as a blueprint of your trading, and it should highlight your time commitments, your trading funds, your risk reward ratio, your trading strategy, your desired profit loss week over week or month over month. And also, I think, take in consideration the emotional qualities that you would like to achieve after each given period, because sometimes as a trader, your emotions can actually cause you the most problems. Even if you're successful, you may not feel very satisfied in this profession or in this pursuit if you're pursuing it on the side. So keep that in mind. For instance, a trading plan could say that you are going to commit 1 hour every morning and evening to trading, and that you will never commit more than 2% of the total value of your portfolio to any trade. This can help minimize losses and limit the effect of emotions on your trading, as the rules for opening or closing a position are already stated there. Trading plans should also take into account these individual factors that could affect your discipline, such as emotions, bias, and personality traits, and just understand them as I stated once you begin. And also remember to not overtrade. This is another big problem. It's not just undertrading, it's overtrading, which can actually become more of a problem and addiction and can actually cause more disruption to your trading long term. The next thing here is to have patience. Patience is so important in the stock market, whether you're a day trader, swing trader, long-term investor. It's integral to be disciplined, and it's crucial that you're patient with your stock positions, whether they're short or long positions. Acting on emotions like fear can lead you to miss out on a profit by closing a position too early, and you must trust your plan, trust your analysis, and remain patient and disciplined. Equally, when looking to enter a trade, it's important to be patient and wait for the opportunity rather than just jumping in or waiting for the pullback if you're day trading and then going in. But always using analysis and looking at the full picture. For instance, if you wanted to speculate on currency, if you're a forex trader and you were looking at the euro to British pound currency, you would want to wait until the right announcement came before getting into that kind of trade, waiting for a certain stimuli, not just jumping in because the fundamentals look good. Fundamentals are very important, but you must also utilize the right stimuli, especially when you're looking at Forex. The next thing is to be adaptive. Super important in life in any area that you pursue. Well, it's important to have a trading plan. Remember that there are no 2 days that the market is the same, and winning streaks don't exist in trading. With this in mind, you should become comfortable in assessing how the markets are different from day to day or week to week and act accordingly. If there's more volatility on one day compared to the day trading before, and the markets are moving particularly unpredictable, you may decide to put your trading activity on hold until you understand what's actually happening in the market. And being adaptive also can help limit your emotions and rule out the representative and status quo biases, which then allow you to assess the situation of the market on its own merit or on a stock because of its merit, and ensures that you're pragmatic at all times in the market. The next thing is very important. It's taking a break after a loss. Sometimes after a loss, the best thing you can do is walk away from your trading account for a short while you compose yourself, you get yourself put together, and it's often much more effective than rushing back into a trade. You'll notice this, that often when you rush back in, 9 times out of 10 you'll make another losing trade. It often won't go into your favor. And often you also fall into the habit of revenge trading, which is basically where you put everything out there, you don't have any restraint, and it sometimes works, but typically it doesn't, and you'll end up taking a much bigger loss. Remember that the best traders are those that take their losses and use them as learning opportunities, and they will typically collect themselves for a few minutes before jumping back into a trade, or even just walk away for the day. In doing so, you keep your emotions in check and you cool off, and you'll just be more level-headed when you go back into the market. The next thing is accept your winnings. It's just as important as taking a break after a loss is to quit while you are ahead and take your winnings. This is so important. Know when to take the money off the table. A succession of wins or a very large one can make you feel invincible and like you'll always be a winner. And then you'll rush into a subsequent position expecting the same outcome. You may even have a succession of very large trades in the belief that you'll never fail because you've had this amazing day in the market and you feel invincible, and each trade is going to be a winner. And this could take you to taking unnecessary risk and then actually taking a big loss that potentially wipes out all the gains or profit for the day. Or you could also be in an open position where you're up, say, $1,500, $2,500 in a day, which is something I've incurred. And then rather than taking the money off the table, being up 25% or so on a day trade stock, keeping it, anticipating a further movement up, which then can end up becoming a loss. And this is why also you should have certain rules in place when you're in the market. Take the money off when you're 5% up, 10% up, 20% up. Have given rules. The same thing with swing trading or long-term investments. And a lot of this goes back to the same thing. It's about your emotions in your psyche. When you're in the market, you have to keep all of this in mind and be calm and collected. Happiness, of course, can be just as dangerous as anger when you're in the market, and it's important to realize when the euphoria is too much and it's clouding your judgment, just like anger can cloud your judgment. Also is keep a trading log. A trading log will enable you to record all of your losses and wins, as well as the emotions that you are experiencing during a particular trade. As a result, it's the accumulation of all the previous times in the market, all the profits and all the losses, and what factors went into those trades being successful or not successful. For instance, a trading log can also be used to record a time when you chose to cut your loss and the eventual price that the asset hit. By doing this, you can see if you made the right decision or not. And it's also important to kind of record your emotions and how you ended up taking those trades. So, in summary, trading psychology is all about mindset in the market, and it gives you a way to understand why you profit or lost. It's important that you're aware of your own weaknesses and biases before entering a position or exiting a position, and that you also understand your strengths. Learn about your wins as much as your losses, but remember that winning streak does not exist in trading, and that each position should be assessed on its own merit. Also understand when to take a profit or cut a loss, which can be the difference between a good and a bad day in the market. Also, keep a trading log for you to understand what worked and what doesn't, and to be a future reference to help guide you in the future for your day trading.